Good evening. How are you tonight? I'm tired. Man, we're doing the real estate business lately. I know that I give you all kinds of articles explaining how the market is not doing great, but man, I'm busy. I'm listing property, I'm helping buyers buy homes, working with buyers, so it's not like crazy, but it is kind of fascinating that, I'm busy now, and during the main time, I would just literally show property day after day after day with no positive results whatsoever. Offer after offer, just, shot down. No one's interested in negotiating anything. You know, there's going to be so many people miserable down the road if they're not already. Um, but we'll see. So I did want to introduce myself. My name is John Schenk. I'm the founder and managing broker of Deerwood Realty in St. Louis. We're a small real estate brokerage. It's just me. I'm the broker. I'm also the agent. I can have other agents if I want. Nobody's really wanting to come hang out with me and help buyers buy homes and sellers sell theirs. So we go along this path, and I have the Deerwood Realty live stream, and we talk about what's going on in the real estate market. We do look at it from a national perspective. All real estate is local, but there are trends and there are things that are similar across the board. So we talk about those. We try to stretch our minds a little bit. We try to talk about ourselves in the second person or the third person. I'm sorry. It's just me. If you like real estate talk, if you like discussion, and I say real estate, and that's pretty broad. If you like residential real estate, we go over the hot takes of the day. You should probably hang out with us. It'll be fun. Channel's growing, and I'm glad. So now that's out of the way. Let's talk about what we're going to talk about tonight. We're going to talk about mortgage rates. Obviously, we're going to talk about. I listed 2 condos in the past 2 weeks, and I kind of wanted to show you the videos from YouTube. Someone didn't like my YouTube short. One of them. We'll talk about that. We'll talk about the Google Trends article. That's going to be exciting. We're going to talk about some stuff I saw on Twitter, and then we're going to have some news and commentary. A company in Canada properly not doing well. Then we're going to go to an article from a real, somebody that's a real expert in the iBuying space. And then we're going to talk about, if you're going to college and you're studying to be, somebody in the real estate field, you might want to rethink that if you're planning on graduating this year or next year. The job market might be down a little bit in those fields. So yeah, that's what we're going to talk about. The first thing I want to talk about, though, is I want to set this up just right. So I'm going to go there. No, I'm going to go there. And then I'm going to do this. And then I'm going to do this. I want to share my screen. And hopefully we can go over the really kind of the most important news of the day. It has been a trend for quite some time. And that is mortgage rates. Where are mortgage rates going? We look at DeerwoodRealtySDL.com. It says 30-year fixed is 6.61%, eased off from 6.65% yesterday. What does that mean? Well, the Fed really, really wants to have the spread between the borrowing rate and mortgages be a little tighter. That's one thing. That's happening. I don't know if that's a good thing. We're going to talk about a lot of things that are pretty high-minded today. I may not be the best person to discuss some of these things, but we'll do our best. I don't know. I'm working with working with some buyers right now, and affordability is an issue. They have a good job. They have a ding or two on their credit for medical collections. And I'll tell you, medical collections are so sneaky. You can have like the insurance say they're not going to pay, they're not going to pay on a claim. You don't even notice it. And by the time you find out, it's already stuck with a creditor, and they're already just marking up your credit left and right. If you're a mortgage, if you're an LO, a loan officer, put in the chat, tell me your experience with medical collections. Is it just me? I don't think it is. But anyway, let's talk about something that not many people talk about, and that is FHA approved condos. What I've noticed in St. Louis, I don't know that it's a trend anywhere else, but what I've noticed is that very few condominium complexes are keeping up with their FHA registration. And so what happens is I might be able to have a buyer buy a unit in that development, but it's an FHA mortgage, and the condominium doesn't conform to the FHA guidelines, and so I can't get the buyer in that unit. And you pay condo fees, right? You pay $200 a month. And some of the reasons why an FHA condo will not happen, an application, is if there's too many rentals versus homeowners. That'll kill an FHA loan, or FHA approved condo. If they just don't fill out any paperwork, if they never ever even apply, that'll keep you from doing it. But I think about it in three ways. Let's look at it in three different ways. One, are the condo boards doing their jobs in the sense that they're being paid an association management fee every month to do X, Y, and Z things? One of those should be to make sure that they keep their FHA approval up, I would think. Number two, are condo associations just intentionally not filling out the forms and not complying with the approved FHA lenders because they don't want those people in their units? And then is that, like some sort of blanket racism or blanket effort to keep people out that wouldn't otherwise be able to be in those units? I don't know how you'd go about proving it. I just know that to me, it's important. Like, you didn't see FHA a whole lot right now in the really, really hot market because people were afraid to go FHA. But as the market cools, excuse me, and house prices go up, some of these people, the only way they're going to be able to afford a condo or a house is through FHA. And so I think it's like, I think it's malpractice to not be able to have an FHA approved condo. Let's just do one zip code. I went to 63125. I always look up condo approvals before I have a listing. But there are some zip codes like 63125. It's the Bayless School District here in St. Louis. It's in the county. Great school district, great area, good value. And there's not one condo complex that is FHA approved right now in the entire zip code. Let me know what you think in the comments. Put it in the chat. I wanted to go over that. So now I'm going to try this. Now, please don't make fun of me. I tried to run, I run StreamYard. I tried to run my listing videos through StreamYard, but my computer lagged and it was terrible. Obviously, I need to get a new computer soon, but I'm just not there yet. So we're going to try it just on YouTube. Wish me luck. I just want you to see, I put up 2 listings in the last 2 weeks, both condos, both similarly priced, different parts of town. Let's look at this one first. Go here. I do want to do that. I don't know if you can hear me, but this is one of the condos that I did, and this is one of the videos we did. Now there is music and it is nice, but I don't want to get a copyright strike. And I haven't on the 2 videos, but I don't want to start. So I'll narrate a little bit. This is the master with a walk-in closet. Here's the upstairs full bathroom. That's the second bedroom. It's a pretty good size. And then this is downstairs. This is a little section down there, kind of flipping back and forth. You can have like a little living room and you can have a bedroom, but it's not counted as a bedroom. And then there's your outside patio where you can have your grill. It's a nice place. I want to run it one more time because we were talking right at the beginning. So here we go. So this is the living room. It looks pretty sweet. So that's 3 jobs into there's your half bath on the first floor. And that's your little eat-in kitchen space. And then to the right, there's the kitchen. There's the kitchen, all custom cabinets. Looks good. Then you've got the upstairs. So yeah, that's one of my videos. Hopefully, it didn't lag on my end. Hopefully it didn't lag on yours. If I'm, I know you want to listen to music, but I don't really want to get a copyright strike tonight. So that was one of them. And then let's look at another. I could have gone and done it this way, but we'll go down here. Here's the one I listed just literally 3 hours ago. Let's take a look at that. There's me. I'm a CEO today. Okay. But I mean, these are real, this is how I do my listings. This is a real camera crew. And I mean, I don't know that anybody's now. What's funny to me is, when the market's hot, nobody cares about how you present your listings. I think as a listing agent, you should do the best you can and present the listings in its best light possible. And so, why aren't you getting video? And if the excuse is, well, it'll sell no matter what we do. Iffy. But they did a real nice job with this one. I was really proud of that. So anyway, those are the 2 listings. I do want to just check and go back. Okay, good. This is our Google Trends article for tonight. How many people do you think there are in the world? Do you think there's 8 billion? That seems like a lot. $8 billion people? World population expected to reach 8 billion this week. India to overtake China to become the most populated country. It took 12 years from the global population to go from 7 billion to 8 billion. Can you imagine? That's a lot of people. It says the global population is expected to hit 8 billion on Tuesday, according to a report by the United Nations Population Division. This year's World Population Day falls during a milestone year where we anticipate the birth of the Earth's 8 billionth inhabitant. This is an occasion to celebrate our diversity, recognize our common humanity, and marvel at the advancements in health that have extended lifespans and dramatically reduced maternal and child mortality rates. At the same time, as a reminder of our shared responsibility to care for our planet, a moment to reflect on where we still fall short on our commitments to one another. We just absolutely disagree with each other. According to the United Nations Department of Economic and Social Affairs Population Division, India will surpass China as the world's most populous country next year. The global population has been growing at its slowest rate since the 1950s, falling under 1% in 2020. The global population has been growing at a slow rate. The latest projections by the UN show the global population might reach 8.5 billion in 2030 and 9.7 billion in 2050. It's projected to peak around 10.4 billion during the 2080s and remain that level until 2100. I'm just going to do some calculating here on my phone. So 58 years. Okay. It's going to be 10.4 billion. And I'm 45 years old. I'll be 103 when the population is 10.3 billion. I don't know that I'm going to make it. Part of me says I would like to, but part of me says not looking real likely. I do wonder if they take into account like terrible world wars and things of that nature. It's not something I'm looking forward to, but I'm just saying, like, you know, be awful odd if there were no like killings between now and 2080, considering the way history has gone so far. A lot of people, I think, in the United States think it's getting like we're getting so many people. It's so busy and so, so not what we had before. And I don't really see it that way. I mean, like a lot of the places that I've noticed, like say in St. Louis, during the 1980s, there weren't a lot of people living downtown. Now there are more people living downtown. Why is that? Well, I think it's population growth. But like I said, I think a lot of people think that the United States is getting like crazy overcrowded. But we're not even close to like the higher level growth countries like China or India. I mean, they've got some serious people. I don't know. What do you think? Put it in the chat. Put it in the comment section. Let's do tweets. Oh, no. I got one more thing to talk about. Let me go back. Okay. Let me do this here like this. I'll go here. Okay. And then I'm going to do this and this. I want to talk about something that happened to me. I had a YouTube short. Now, do you ever comment on YouTube shorts? I don't. I don't have time for that. But I had a comment on YouTube shorts that said that I was not it was a terrible video. The short that I had, it was about a trip to the dentist. It was like a rambling and I just don't like it. And it's like, so I wrote back a reply and I just said, I'm sorry that you feel that way. I mean, what do you want me to do? Be better. I think we all want to be better. Be the top live streamer in the world. Well, I think we'd all want to be that, but it doesn't happen overnight. I don't think. I do think your personality has something to do with it. I do think you can get better. I think I've definitely gotten better since last year. You tell me. I don't know. Sometimes I get streams that I have like a ton of people on them, and then sometimes I have streams where there's no one. I haven't really figured out why that is. Like, what am I doing wrong? I do watch the YouTube people and they say like you should post a video once a week. Well, I don't think you should live stream once a week. I think people want to see you more often than that. And then I don't know. Yeah, here's what the point I was going with. They say you should do quality over, quantity. But, if you're not careful, you're stuck just trying to make the perfect videos and trying to do the perfect live stream and have the perfect amount of information. And it's like, I can either spend a little while and get something together and put it out there, or I could spend a week or a month and then put something out there. And I could probably still get the same amount of views as if I just did something every day. So YouTube's a strange place for me. Like, I had a YouTube short 2 days ago. I had 600 views on it, and for me, like, that's, amazing. I don't normally even have I don't even normally have 10 people on a live stream. Now I'll have on the replays, I'll have people watching. But so anyway, I had 600 and I picked up some subscribers and it was really great. And then today I followed it up with a YouTube short about the dentist and I had like 100 views. I mean, I don't get a lot of views on my YouTube shorts either, unless all of a sudden it'll decide to do it. It's very odd. And in fact, the one that had so many views was not really any of my best work, at least in my opinion. Moving on. This was a tweet from Steve Saretsky. He says he's a real estate aficionado, Vancouver realtor and investor. So, all right. So it says the national house prices fell another 1.2% in October. The home price index has dropped 15% since its peak earlier this year, the sharpest decline since the index was created in 2005. In other words, the price of a typical home has dropped $132,900 since March. So then someone said, "Hey, look at this article there. They're like, Canadian home sales rose last month for the first time since February." He says, "Sales, yes, not uncommon for October." Now, you can have sales rise and prices remain similar, or go down or go up a little bit. Wouldn't be a surprise. Wouldn't be weird. The thing that I feel like I'm seeing is that inventory is starting to roll over a little bit. And by roll over, what I mean is, like, during the boom, there was a day where I went to look at, like, I happened to be in 63125 again with some different buyers. And I was like, man, we've seen every house on the market in 63125. And that was like 3 houses. I'm like, that can't be. Let's go see if there's anything that's 30 days or more over, 30 days or more over on the days on market. So I looked, there was nothing. In fact, there was nothing that was more than 7 days. Nothing more than 7 days on market. Yeah, I'm so sorry. I'm so tired. I've had a rough go. Anyway, and my nose itches. Oh my God. Anyway, so now there's a lot more inventory, and then inventory. Here's what the mistake people are making in their pricing is they're coming to market higher than anything that's sold in the neighborhoods, even during the good times. So let's say in May of 2022, a house sold for $300,000. Well, these agents and sellers are like, okay, well, we'll come in the market at like 325. Like, why would you do that? Well, you would do that because look, I mean, this is a nice house, and the buyers, or the sellers, they think highly of their house, and they're not gonna list it for less than what somebody did in May. But what they don't understand is that the affordability equation is just out the window. You go from sub 3 mortgage rates to 7 and above, and it's like, and you could say, John, come on, let's be honest. It's not 7%. It's like 6.4% or 6.6%. Yes, you're right. But we've been hovering in that 7% territory for the last 2 weeks. So I'm just trying to illustrate a point. I thought that was an interesting tweet. Moving on, Darth Powell. There's no housing wealth effect. It's transferring wealth from buyer to seller. Seller gets the cash. Buyer services the debt to produce that cash. Seller can buy more. Buyer can buy less. It says, assuming, and then somebody else wrote Mile High Fire, assuming the house is bought at fair market value, there's no wealth transfer. It's a net wash. But the house is an appreciating asset, so the buyer's wealth will likely increase over time. The seller holding cash will lose buying power over time due to inflation. So the idea is just modern finance. The idea is $1 today is worth more than $1 tomorrow. Okay. So anyway, then he comes back and says, so let's say I buy a house for 200,000, then I sell it for 500,000. Let's call it a second home. The case shows that shows over time, home values only appreciate at the place of inflation, which should be correct. Anything in excess is a wealth transfer. And then this other person wrote, the seller usually can't buy more unless you ready the move to the Rust Belt, which makes the whole thing even more ridiculous. It only benefits investors. Buy. Unless you buy the move to the Rust Belt. I don't know. His point is, like, let me interpret. See, that's what I was talking about. We're doing this highfalutin stuff tonight. The seller gets the cash. So they get, like, say, $300,000. Okay. And then the buyer services the debt to produce that cash. So when you buy the home, now you're servicing debt from the past. That's what he's saying. I don't know if it's true. I think it is. I mean, how else could it be that you buy a house and, like, nothing goes on, like, you don't do anything to it, and then 5 years later it's worth like 20% more or 30% more? That's a financing issue. It's not because you've not done nothing to the house and for some reason it's worth more. I mean, that kind of turns depreciation on its head, or the theory of depreciation, because it's not depreciating. Anyway, let's not. It was a very interesting tweet. Second tweet tonight. I thought this was interesting. It says, this is from Lance Lambert. He writes for Fortune. The Dallas Fed paper argues that achieving a soft economic landing cannot be taken for granted, given that further monetary policy tightening can increase the household mortgage debt servicing burden and boost the odds of a severe house price correction. Okay, let's read that because it's kind of hard. Further monetary policy tightening can increase the household mortgage debt servicing burden and boost the odds of a severe house price correction. So that would mean, like, so say you buy a mortgage at 7%. Okay, you buy a house with a mortgage at 7%. Just your servicing of the debt is so much higher than someone who bought the home at 3%. Okay. And then so you're just paying on your debt, and it's such a burden that you may decide you're not going to after a while and you just quit. I don't know. Here we go. He's quoting the Dallas Fed. Plausible estimates of the direct impact on housing wealth suggests that a pessimistic scenario with a real price correction of 15 and 20%, a negative wealth effect on aggregate demand, would further restrain housing demand, deepening the home price correction and setting in motion a negative feedback loop. In the current environment, when housing demand is showing signs of softening, monetary policy needs to carefully thread the needle of bringing inflation down without setting off a downward house price spiral that could aggravate an economic downturn. And that's where I'm at. Is once you pull the plug from the real estate market, okay, now all of a sudden plumbers, electricians, those people don't have jobs. And then, so once they don't have jobs and they can't afford it, so that further lowers the asking prices of homes. I mean, that's what my big concern is. But inflation is worse. A gradual unwinding of the pandemic housing excesses can occur if policymakers can quell inflation without putting buyers under too much stress, and can slow house price and rent increases while keeping underwater mortgages from rising. That is something. And let me take this opportunity to go over. There's a lady, a real estate agent, Kira Mason. We're going to look at a tweet of hers. The other day, somebody jumped all over for saying that, the mortgage price dipping below the mortgage 30-year fix below 7% might cause a few more people to buy houses because they can actually afford the ones they're looking at. And someone went after and said, like, that's what realtors always say. But I wanted to take that a step further. During the housing crisis in 2007, 2009, the Fed did things that they had never done before. And so you would never have anticipated the Fed bailing so many folks out. There's nothing to say that they won't do that now. I mean, if you get behavior of home buyers during the pandemic, literally just walking away from their homes because they don't want to make the payments anymore on something that they don't feel has any value to it, that's a serious problem. I'm just putting it out there. That's why I don't like when people prognosticate into the future. You never know what crazy government policies are going to be put into place to fix one problem that might actually end up causing another. It said a gradual unwinding of the pandemic housing excesses can occur. Policymakers can quell inflation without putting buyers under too much stress and can slow house price and rent increases while keeping underwater mortgages from rising. And that's the thing is like, there's an argument by, I think Mark Zandi, the economist, would make this argument. He would say that the lenders are so good at their lending that we don't have people in homes that can't afford them. My counter to that is look at what you would have to make. That's one of the last tweets we'll have tonight is, what do you have to make just to afford a median home in the United States? It's more than like 20 grand a year. It's a question of how much more. And so that alone to me might cause mortgages, to not get paid, especially when these people lose their jobs. Households and financial institutions are in better shape than during the housing boom and bust in the mid-2000s. See, that's like baked in. They just automatically believe that, likely providing more of a cushion to withstand some of the consequences of a negative wealth effect were one to materialize. It's a negative wealth effect right now. However, after a housing boom partly driven by pandemic-era fear of missing out beliefs, cooling market participants' expectations is key to shifting house prices toward a more sustainable path and avoiding the peril of a disorderly market correction. Well, they had a disorderly market for the last 2 years, kind of fueled by low interest rates. A severe housing bust from the frothy pandemic run-up isn't inevitable. Although the situation is challenging, there remains a window of opportunity to deflate the housing bubble while achieving the Fed's preferred outcome of a soft landing. We don't agree. This soft landing is more likely to happen if the worst case scenario of a price correction induced economic downturn can be avoided. Somebody wrote, last year they said inflation was transitory, but here we are. We were cheering this week over 7.7% on the CPI because it wasn't 7.9%. This is another, I don't know why I picked difficult tweets tonight. I'm sorry. Jeff Winiger. I think the NFIB hard jobs to fill is going to take a tumble in 2023, and it is deteriorating. JOLTS data will dominate Wall Street headlines. Also, the consumer's marginal propensity to consume will be affected because people have heard labor shortage for so many times. So what do we all think? We all think we can just go to another job, right? We lose our job, we'll just go to another one. Everything's fine. We didn't like that company anyway. The new company's going to treat us so much better. Housing starts peak job ability. So this bottom line, percentage of firms with one or more hard jobs to fill going up, 12-month average new housing starts going down. Since COVID, that they may have become convinced. Also, the consumer's marginal propensity to consume will be affected because people have heard labor shortage so many times since COVID that they may have become convinced that the 3.7% unemployment rate can't really rise too much. Very big mistake. If I lose my job, I can easily find another. There's a labor shortage, I don't think for too long, not if I'm a little right on this housing situation. That's what I think. Here's Cure Mason. Realtors generally look at comps from the last 6 months when helping sellers price their homes, but a sale from July has very little relevance in today's market. Better sources of valuation info include active listings, pendings, showing activity. We're in the process of creating the comps for this new market. There are few sales to refer to. We need to be creative and keep our eyes open. Well, she's exactly right. Just understand that the last comp that you have, the most recent comp that you have, is the best comp you're going to have. So, yeah, you're right. If something sold in May or June, to me, it's just not going to work out. You need to be pricing your property way below what something had sold for, based on what I see, if you want to sell your house. Daniel DiMartino Booth, a pessimistic. Now, this is talking about the Fed research. It's just talking about it differently. It says a pessimistic scenario where prices now retreat by 15 to 20% could subtract 0.5 to 0.7% from inflation adjusted consumer spending, according to the Dallas Fed research. Pessimistic scenario where prices now retreat 15 to 20. So that's like the worst case scenario. It'll take off 0.5 to 0.7. Yeah. God. From inflation adjusted consumer spending. That's very interesting. Charlie Biello. This is the one I thought was interesting, or Bilello. A U.S. homebuyer now needs to earn a record $107,000 to afford the median priced homes for sale, an increase of over 45% in the past 12 months. See, this is not good. A U.S. homebuyer now needs to earn a record $107,000 to afford the median priced home for sale, an increase of over 45% in the last 12 months. You know, this was kind of cool. It says what home buyers need to earn to afford median prices in Tampa is $102,000, and then San Francisco's the highest is $403,000. They need to earn $403,000 to afford a median-sized home in San Francisco. Crazy. I may not see $400,000 in my life. This is a trend that I wanted to go over. Okay, so there's been all these companies that are called proptech companies. They're companies that, to me, don't even make a profit, and then they get funding from venture capital, and they're like, we're going to help you grow, and don't worry about it. And then when they stop getting like any chance, or when they stop seeing any chance for return on their investment, they start getting vicious, and they start making changes. They start telling the CEO, look, if you don't fire these people, we're going to move. We're going to stop. We're going to give you any more money. And so then they have to adjust. But to me, real estate tech companies, prop tech, not a good investment in the first place. I mean, real estate's 100 years old, much longer than that. There is a way to do it, like we know kind of how it goes. And what I know to be sales talk is like, you'll see someone say, we're going to innovate real estate space. You're not. There's nothing you're going to do to innovate the real estate space. But they'll say, like, we have AI that helps us do this, and we have an app that does that. It's all bullshit. So anyway, let's read this. They got rid of some people. And then let's go into it even further. Like, here we go. Ready? So, important changes to the Properly team. After a company-wide all-hands meeting earlier today, Properly co-founder and CEO Anshul Ruparel sent the following note to Properly employees. This is not the type of day that Greg, Sheldon, or I ever imagined when we started Properly. At our all-hands this morning, I announced the hardest change we've had to make in our history. Today, we'll be saying goodbye to 71 of our friends and colleagues. We're very sorry to be taking this step, and I take responsibility for the choices that brought us here. You know what, dude? Taking responsibility doesn't really mean anything. Mark Zuckerberg takes responsibility for it too. But I mean, at the same time, he's crying on a pillow of money. You see, he still has a job. Oh, that's right. He doesn't have a job. He has shares in one of the largest companies in the world. How did we get here? In the summer of 2021, when we started to rapidly grow our organization, the world around us looked very different. We were riding a historic wave in both real estate market and startup funding environment. That's right. That's another thing that they don't talk about is when you have low borrowing rates, this free money flows into very bad investments. The new reality is now we're experiencing one of the most significant corrections in the history of the Canadian housing market. Conditions have deteriorated much faster than we anticipated. We cannot predict when the market will recover. I'm accountable for the decision to expand our team to support a level of scale and growth that is now clear we will not materialize in the foreseeable future. For the individuals and families impacted by these choices, I'm truly sorry. Even this public declaration of failure, it's like let me try to explain this the way I see it. You can tell me if you think the same way. So I'm a CEO of a company. I have millions of dollars that were just handed to me. Okay. And it says, well, no, you don't really have millions of dollars. It's all in stock. And so if the stock doesn't do well, you know what? It doesn't seem to work that way. It seems like you get a salary or something for working there. So anyway, now you're like, okay. So then you're like, I need to fire a bunch of people because our company's not doing well. Okay. So then it's like, I feel really bad and I take responsibility that I have to fire people. You should feel sorry for me. You should feel sorry for me. I have to fire these people. I made mistakes that other people are going to have to deal with. And by publicly declaring that I feel bad, I feel shame, and I'm sorry, you should feel sorry for me. Don't pay attention to the money that I make. Don't pay attention to that. You need to feel sorry for me because I'm having to make these tough decisions that I take responsibility for. See what they do? See how they twist it? Supporting our departing team members. As founders, we care deeply about and have tremendous respect for the team who has helped us build. We are eternally thankful for your contribution to our culture, team, and mission. Now it's like, look, I'm going to tell you how great you are as I'm watching you go out the door. For those of you leaving, we know that neither our words nor our actions will alleviate the shock or impact of losing your job. We're prioritizing supporting you as best we can for your next step, like including. So, like, we're firing you, but we feel bad about it. And so you need help because we just fired you. So here's the steps we're taking. We're going to give you a generous severance package with more for those longer tenure, extended health and dental benefits, mental health and well-being support, accelerated equity vesting for those who have not reached their vesting cliff, and a 4-year exercise window for vested options, dedicated ongoing support in helping you find your next opportunity. We're going to help you find a new job. The ability for your the ability to keep your laptop and other equipment. Hey man, you're getting fired. You just go ahead, take your laptop, put it in a box, and get out. We'll work on your mental health. Just call us. Working with the incredible people at Properly has been the privilege of our careers. Our departing team members, the people we've fired and let go, were among the most talented and passionate people we've ever worked with. Then you wouldn't let them go. Quite frankly, you would find a way to keep them. Letting the world know about the talent now available to help start, scale, and transform the companies of the future is why we plan to post a public version of this announcement. We'll also be creating it. We have such talented people that we're going to broadcast that we're getting rid of them. We'll also be creating a talent directory, are engaging and personalized our outreach to our networks to support you in finding your next opportunity, and creating an alumni at properly.ca email for people to share job opportunities that we will direct to our alumni. This is insanity. What I'm reading. Look, you just lost your job, okay? Or you're going to, okay? And this company says they're not going to focus. Like, this company's probably hemorrhaging cash, okay? They needed to fire you. You had to be fired, or else they'd have to fire themselves, and they're not going to do that. So now they're going to piss away time, energy, and effort on finding you another job. This is why they're not successful in the first place. They're spending their time worried about these people that they're firing. By the way, very unceremoniously in the sense that they're doing it out in public. We're going to leak this information out there, or we're going to post this information out there so that people know how bright and talented you are. What happens next and then look at this. I mean, it's like the Hunger Games or whatever. Within the next 30 minutes, all members of the properly team will receive an email letting them know how they've been impacted by today's announcement. Basically, hey, in 30 minutes, we're going to let you know if you're fired or not. See, it's this soft speak that I was never good at. If I would just be more, soft spoken, I could have been a CEO and lost a bunch of money for people and then just blamed myself while I slept on a bed of money. Departing employees, it's like you're taking a trip. We're taking a trip. Will be invited to individual one-on-one conversations with a member of the leadership team to take place between 10:45 and 3. Why? What's that conversation going to be like? So I'm fired, eh? Yeah. This sucks. Yeah. I still have my job. Oh, by the way, we're gonna worry about you after you've left. Good luck. We will soon be disabling access to all internal tools to protect sensitive customer data, but we'll leave emails active until 1 p.m. so that you can elect any personal information and say goodbye. You have between 10:45, and 1 to get all your stuff out of your email because we're getting rid of your email address or we're locking it after 1. Remaining employees will receive an email letting them know that they are not included in the reduction. Tomorrow, each of you will be invited to a one-on-one with leadership team member to discuss these changes further. Why do we have to discuss all this? Why can't we just do work? For those of you who remain in the wake of this change, it would be naive of me to suggest you two are not affected. We appreciate your patience and partnership over the next few weeks as we create a new future together. There will be many more opportunities for reflection, discussion, and collaboration in the coming years. To those who are departing, we're so thankful to have worked with you and are deeply appreciative of all you've done to make probably a great place to work. We're committed to supporting you in all ways possible, and that does not end today. Sincerely, Anshul. Now, look, I think that this whole process is because of the way the better.com guy fired all his people. He's just like, hey, if you're on this call, like, you don't have a job. It was vicious. He had to go to therapy for it, they said. He had to atone for his evil ways. This is so just our last article tonight is going to go through this too. So let's just kind of put that off to the side. This is Mike Dilpreet. I can't say his last name because I've never heard it pronounced. He is like on top of Zillow and Opendoor and all these technological wonders that can't seem to make any money. 1 year later, Zillow offers an Opendoor. It says, here's your net loss. Opendoor lost $928 million in a quarter. That's 90 days. $90 days. You lost $928 million. Zillow at the time, their offers in Q3 of 2021 lost $422 million. The write-downs, plenty. Net loss home sold. You're averaging losing $42,000 per home. You're losing that. In the worst part, Zillow last year was losing $39,000. Write down of the home is $34,000 and $31,000. Last week, Opendoor announced that it lost nearly $1 billion during the third quarter due to the results of selling too many homes at a loss. This is the issue. I was told last year that Opendoor was they were so much smarter about how they bought homes than Zillow was. Exactly 1 year ago, Zillow faced a similar situation with iBuyer Business Zillow offers and subsequently shut it down. Shut it down. Shut it down. The cause and effect in each case is similar with nearly identical financial implications, but the path forwards differ. Zillow did some things that made people angry as far as real estate agents. Like, I don't trust Zillow at all. Maybe some of you do, but Opendoor's net loss of $928 million for the quarter is more than double of Zillow's offers net loss of $422 million. It's a matter of scale, though. Opendoor sold more than twice as many homes as Zillow at a loss. The net loss also includes significant inventory write-downs, $573 million for Opendoor and $304 million for Zillow. On a per home basis, each company incurred similar losses. The write-down per home inventory is nearly identical, showing that both companies were guilty of unintentionally purchasing homes at higher prices than current estimates of future selling prices. It was such a risky idea. Do you know how much time you really have in the housing market when it turns? You have about a month. Do you know how long it takes for a house to close? Typically, a month. And you can be buying houses in the market just throwing up on itself. And what are you going to do about it? That's what they did. And then Zillow's decision to shut down Zillow offers in Q3 2021 likely protected the company from at least $1 billion of initial losses. Oh, easily. Easily. They were buying houses like drunken sailors. It also returned the company profitability and removed the uncertainty of wild profitability strings. Well, you don't have to worry about profitability right now if you're an iBuyer. Meanwhile, Opendoor will endure at least 6 months of unprecedented financial losses. What to watch? Opendoor is making significant changes to reduce its risk in response to the volatile real estate market. It's buying significantly fewer homes and making lower offers on the homes it does purchase. Well, that's the problem, though. Their real job is to go in and buy houses. They have to buy houses to make money. The company lost a new asset-light marketplace to connect buyers and sellers without Opendoor actually purchasing the home. Opendoor has also quietly shut down its entire mortgage operation. They couldn't even make it. Like, these companies have, look, I finance myself. My company gets financed. If I sell a home, I take a significant portion of that money and I finance my operations going forward. Okay? It sucks. It's hard. I can't imagine I can't imagine having $1 million behind me. $1 million. I can't imagine having $1 million. These people get billions and they can't produce because the model is crap. It works in a good market, and it doesn't work in a bad one. Key learnings: it's very challenging for an iBuyer to respond to sudden market volatility. It's especially in changes of home price appreciation. It's challenging for an iBuyer to respond to anything. At the desired scale iBuyers want to operate at, the result of downward pricing pressure can be financially catastrophic. Yes, asset light, but not actually buying the house, is taking more prominence in the evolution of the iBuyer business model and is a key component of the power buyer model. Bottom line, in retrospect, Zillow's decision to shut down Zillow offers was the right call. It prevented additional losses, preserved the core business, and positively refocused the company. But while Zillow offers folded, Opendoor has no choice but to continue on a challenging and volatile market, making adjustments to its business model as it goes along. Yes. Like, what will they become? What happens when you can't do any iBuying and make any money at it? We'll find out, I guess. I guess the people that loaned you all that money will be able to loan you more money. But then here's the problem. It's really easy to get money when money is flowing. At 2%, money's pretty much free. Start getting mortgages and borrowing at like 9-10%, and just paying that debt's a little dicey. Let's look at our last article tonight. I am so tired. Good Lord. Okay. So let's say you just graduated college with a degree in finance and you go take a job at Redfin. Your family's so proud of you. You got your first job. You're a finance guy. You're going to do big things. and then the market turns and you get thrown out the door. And then you don't really rebound very well. And then, like, every year, like, more and more people are finance majors and they're younger. They're more willing to go to work for less. And you're kind of like, what about me? That didn't happen in my life, but I could see it happening in many others. Layoffs are crushing the real estate industry, and Redfin and Opendoor are the latest victims. Here, 44 companies have shed jobs due to the fast cooling housing market. I basically wanted to just know which ones they were. I mean, we've talked about a lot of them. There's an overarching philosophy that I have. It's not really a philosophy, maybe an idea. Like, we live in an economy where we can have massive, massive growth. Okay. I mean, like, companies can grow just ridiculously fast. Okay. That being said, they can also lose their asses even faster. Like that crypto company, that thing is done. There are many other crypto companies that were involved with that other one. They're going to be done, like, quick. Billions and billions of dollars just wiped away. And I don't think that the modern employment law in the United States has taken into account the way real business is done. Am I asking for the government to step in? Yes, in one sense I am. That is, can we figure out ways to eliminate more red tape so that we can have, like, a more liquid employment space? So that if one company is just eating it, perhaps they could go somewhere else. Right now, your pay is so high that the fear of losing your job every day is not good on your health. Whereas, 50 years ago, the company was going to take care of you for the rest of your life. We don't live in that world, yet our laws are written from that time. Let's go. The layoffs at Redfin and Opendoor are the latest signs of trouble for the embattled real estate industry. Deals that were once profitable for the industry and home purchases that had been affordable for everyday people have been getting slammed by, or because of the higher borrowing costs. The aggressive interest rate hikes by the Federal Reserve and a looming recession have resulted in layoffs galore across the real estate world, whose stormy seas have triggered worry elsewhere in the economy. The cutbacks are sobering for an industry that just a year ago was flying high with home price appreciation, increasing rents, and plentiful funding for proptechs. That's just it. You don't want all this funding for proptechs. They're not good investments. The downsizing began in the mortgage industry with Better's Zoom layoffs at the end of last year. That was that issue when I was saying that, like, once that guy did that, and he was just crucified for it, and maybe he should have been, you knew that CEOs were going to basically pay for someone like a trauma expert to come in and tell them how they're supposed to speak when they're just getting rid of people left and right. That abrupt move came amid expectations for a big slowdown in 2022, and residential brokerages like Compass, Redfin, and Side, I didn't even know there was a company named Side, followed suit as transaction volumes skid. With signs of distress spreading through the office market and among home builders and rate hikes anticipated in 2023, layoffs are mounting. The Mortgage Bankers Association, the industry's largest trade group, anticipates an attrition rate as high as 30%. Indeed, more industry jobs are likely on the line, with demand for mortgages now at its lowest level since 1997 per the MBA. Some of the latest and notable casualties came from real estate marketplace giant Zillow, consumer lender Finance of America, and international vacation rental company Vacasa. Insiders keeping track of where job cuts are taking place in the residential proptech sectors, including at companies that have wielded an axe more than once. These companies with layoffs are listed below in alphabetical order. Okay. And then it says, do you know of any real estate, tech, or mortgage-related layoffs were you affected by them? Email the people. Okay, so Anywell. I mean, we're just trying to learn about these companies and just, like, does it sound like this would be a viable company in a crappy real estate market? Okay, shall we? Israeli proptech Anywell, a company that creates hybrid workspaces, announced in August it will lay off 50% of its workforce in restructuring. The move impacted 11 employees, primarily from Anywell's operational staff. Anywell's latest round of funding or layoffs came just 5 months after it raised $10 million in the Series B round. A total of 14 employees have left the company since March. The company added it plans to focus on software-based solutions. To what? Anyway, 11 employees, 14 employees, not too bad. Apartment listing services are facing mounting economic pressure. Matthew Woods, CEO of apartmentlist.com, announced on LinkedIn on August 31st that the company was laying off 29 people, or 10% of its workforce. Woods said the company was reacting to market conditions. Apartmentlist.com. I want to just look that up. I want to look that up. I don't know. There was one company where they were just writing wonderful articles, wonderful SEO quality articles, and then they just disappeared. I thought it was apartments.com or something. It wasn't apartmentlist.com. It doesn't look like, unless they rebranded since I looked. Better.com, the online mortgage lender. Better, the most ironic name ever for a mortgage company laying off people. Earlier than most companies on the list in December, Garg cut 900 employees via Zoom, a move that made headlines around the world. Before the layoffs, Better employed about 9,000 people, 7,000 of whom were hired since the start of the pandemic. Crazy hiring and crazy firing. The company has since announced another wave of layoffs, cutting 3,000 more employees in March. Wow. Insider reported some employees found out they were being laid off when their bank statements received direct deposits for severance payments, or when they abruptly lost access to their work computers. See, that's why that CEO of this company that we were reading about earlier, he told them, like, hey, you're going to lose your email access at this point in time. He's giving them the heads up. The company, which said it still plans to go public this year, announced a voluntary buyouts for employees in some positions and apartments in April. Garg Better and the blank check company trying to take the mortgage company public have received formal inquiries from the SEC about their business operations, and the company's former chief operating officer's claims about corporate malfeasance. That's not good. Blend, publicly traded mortgage tech company that builds software for other mortgage lenders, laid off 200 people. The company had been signaling it had hard times ahead since the end of last year, as declining loans were forecast to hit the company just as hard as its clients, who were the ones actually lending. Apparently, they don't want your software when they can barely afford to stay in business. Bungalow, company that turns traditional single-family homes into apartments and co-living spaces for roommates, laid off 75 people, or 35% of its workforce in June. That's a neat idea. Traditional single-family homes and apartments into co-living spaces for roommates, because that's what you really want. Company raised $75 million last year from a mix of investors. The round valued the company at $600 million. Clear Capital, like, I've never heard of some of these companies. That's why we're just going through it. Maybe one of them's got something I'm really interested in. Clear Capital, the real estate appraisal technology company, laid off 27% of its workforce. Wow. The layoffs will impact 378 employees as a result of the company's as rising interest rates result in significant decrease in volume from its customers. Interesting. So, it's like we don't need that many appraisers anymore. Compass, the largest brokerage, I think, in the United States, maybe. Residential brokerage now laid off 10% of its workforce, 450 employees in June, as residential transactions slowed down. The layoffs did not include real estate agents who are independent contractors and not directly employed by the company. Compass went public in 2020 at roughly $20 a share. It's down almost 80% over the past years and trading below $5 a share. The company also plans to combine some offices and pauses its plan to expand and acquire other companies. Well, that probably is a good idea. A laid-off employee talked to insiders Zoe Rosenberg about their experience. My lingering thought is that whatever the impacts of the IPO and the impacts of our rapid expansion across the company, the impacts of the market on our futures is just that impacts didn't seem to be handled appropriately or in the best manner for the associates' longevity with the company. I don't know. They're probably depressed that they lost their job. Divvy Homes, rent-to-own real estate company, laid off 40 employees. The San Francisco-based company has raised more than $1.5 billion since 2017 and is backed by large investment firms such as Anderson Horowitz and Tiger Global Management. Although we recognize these macroeconomic challenges late in 2022 and took steps to substantially reduce our cost structure in response, it wasn't enough. Realistically, the macro environment is likely to remain volatile and challenging for the foreseeable future. As a result, we need to adjust headcount to reflect the new reality today. It's just difficult. Finance of America Mortgage laid off hundreds of employees between the second and quarters of 2022. The layoffs impacted employees in the U.S. and the Philippines, where workers perform back office tasks such as appraisal checklists. First Guarantee, Plano, Texas lender laid off 80% of its employees and paused making new loans. They're not even making loans. That's not good. Fueling speculation that the company was going to go bankrupt, the company is backed by the major asset manager PIMCO. Just a few days after cutting 471 employees, the company filed for bankruptcy protection. With more than $473 million in debt, the company, which originated $11 billion in mortgages last year, had projected it could originate only $5 to $6 billion in mortgages this year. Flagstar Bank ate it? Oh no, they just cut their mortgage staff by 20%. In a statement to Housing Wire explaining the 420 employee layoff, cited interest rates rising at the fastest rate this century. In the first quarter of 2022, the company's mortgage originations were down. Fly Homes, online brokerage service, cut 20% of its staff, or 200 people. The company blamed economic headwinds. The Seattle-based company has raised more than $310 million since it opened in 2016. Some of its investors include Anderson Horowitz, Camber Creek, and Spencer Raskoff. So you know what's up. Austin, Texas-based startup Homeward, which is pioneering the move now, sell later transaction. That's just this. All this is good when you have a certain type of market, and when you don't, it's not good. Homie, online discount brokerage. You do online discount brokerages. Good luck with that. It's hard enough to make money as a real estate agent and not an online discount. JP Morgan Chase, Juniper Square, don't care. Keep, Seattle Home Repair Company, provides home repair services for other businesses such as property managers and large corporate landlords. Okay. Keller Mortgage arm of broker Keller Williams. Keller Mortgage laid off 150 new hires in October, then laid off many more employees in May. Around that, former employees described as big, massive, and huge. The division is largely focused on purchase mortgages because of its relationship with the broker. Kyvie, San Francisco-based Kyvie, which offers loans to real estate investors, has felt the impact of rising interest rates on its customers. The company laid off 14 employees. Knock, a startup that helps homeowners make an offer on a new house before selling their old one, laid off half of their staff, roughly 120 employees. At the time it halted its plan to go public, it had planned to go public at a $2 billion valuation, but instead raised $70 million in equity and $150 million in debt and private funding round that included the movie director M. Night Shyamalan as one of its investors. Landing, fully furnished apartment provider Landing, announced laid off 110 employees in October and reshuffled another 70 positions to different parts of the company. The company was founded in San Francisco, moved its headquarters to Birmingham, Alabama in 2021 with the goal of creating more than 800 full-time jobs in the state. Today, the company has a workforce of nearly 900. Well, they're not out. Mr. Cooper, mortgage lender. Mr. Cooper, formerly known as Nation Star, has two separate rounds of layoffs, one of 250 employees and another of 420, or roughly 5% of employees. Like other mortgage lenders, it was hit hard by rising rates with its direct lending business. These companies couldn't even make it. They had to do the volume or they weren't going to make it. Notarize, Boston Remote Notary Service laid off 1/4 of its staff, or 110 people. While Notarize is not a traditional real estate company, it was boosted greatly during the pandemic by the boom in remote real estate traction. I believe that. Many states loosened their rules about in-person notaries and other traditional closing procedures to allow transactions to continue during the early waves of COVID. Yes, that makes sense. Opendoor, 550 employees gone. Biggest home flipping company known as an instant buyer, iBuyer. Orchard, never heard of them. Startup company helps homeowners buy a home before selling their current home. See how there's like 30 of those companies? That's not a good situation when the market goes south. Picasso, oh no, laid off 30% of its workforce on October 11th. Since its founding in 2020, Picasso has raised more than 1.5 billion in 7 funding rounds, with more than 1.3 coming from debt. Oh man. Oh, SoftBank's involved. There you go. PennyMac, California non-bank lender, laid off 80 employees in October, primarily as Rose. I don't care where. The move comes after the company laid off almost 450 employees across 2 rounds earlier this year. Not good. Really? San Francisco Bay Area company really shutting its operations completely. Closed them completely. Oh my gosh. When it was founded in 2016, Israel sought to simplify real estate transactions by allowing customers to buy and sell homes in a single coordinated transaction. This would have eliminated the need for contingencies and paying 2 mortgages at once. Realtor.com, one of the most recognizable marketplaces in the world, said it was downsizing its workforce. Oh my gosh. Redfin, they never make money. Rhino, New York insurance tech startup Rhino laid off 57 employees. Is one company growing a group of proptech startups that pay renters security deposits in exchange for small but non-refundable monthly payments. Look, if you can't afford the security deposit, you shouldn't be renting. Ribbon, software as a solution company for real estate agents, laid off 136 employees as the company seeks profitability. They were doing like cash loans. Rocket Mortgage, largest mortgage lender in the country, formerly known as Quicken Loans. Oh, I didn't know they'd changed their name. Side, a startup that provides white label brokerage service like marketing tools to independent brokerages, laid off 10%. Why do I need marketing tools? CEO Guy Gall said in a statement provided to Inman and other outlets the company grew too quickly to onboard new employees, and that leadership decided it needed to slow down growth in the face of a condition of the global economy. Sonder laid off 20% of its corporate employees and 7% of its frontline hospitality staff. They operate short-term rental properties and apartment buildings, including some apartment buildings that operates entirely as hotels. Sprout Mortgage, which touted itself as the largest original non-qualified mortgage, laid off all of its more than 300 workers and shut down operations early this month. The news prompted a class action lawsuit from laid off employees who said they hadn't received paychecks for the last few weeks of work. Well, that's not good. Sunday, a marketplace that allows homeowners to sell their homes to investors who then rent out the homes, laid off 15% of its staff. Tomo, a mortgage startup that focuses on lending to home purchasers. Really? Like, how is that any different than a mortgage company? Vacasa, vacation rental startup, laid off 280 employees. Wow. It says it's struggled to become profitable since going public. The company lost $2 million in adjusted. That's not so bad compared to others. It was better than its projected loss of 15 and 20 million. Yeah. Wells Fargo, they just decided they don't want to do home lending. It's bizarre. They're like, we don't want to be exposed to all this risk. We're done. They were at one time like the number 1 or 2 lender in the entire United States. The Wing, New York-based startup that made office spaces for women. Well, that's just a terrible idea. Not that, look, if you want to design co-working startup spaces, that's cool. But when you want to segment people by sex and no, by gender, it's just no. Zeus Living, furnished home rental company. That's a terrible idea. Zillow, well, we saw what they did. Zumper. While most of the market layoffs have struck the residential purchase market, companies focused on rentals having escaped unscathed. In June, the rental marketplace Zumper cut 15%, mostly in the sales and customer service department. The Real Deal reported it's unclear how many employees were cut. Look, Business Insider, this article has really, really borrowed from the Real Deal as far as who's who they're linking to. I've not done a real good job with the Real Deal. Just saying, hasn't really been that interesting to me. I need to spend more time watching the Real Deal. I need to fix this like this. Okay. I'm going to do that. All right. Well, it's 10:15 Central Time. I told myself Sunday, if I could get through Monday, the week is going to be fine. And then I told myself last night when I was streaming at like 12:30 or 1 in the morning, I was like, hey, if I can make it through tomorrow, things are going to be okay. It's now going to be Wednesday before, if I can make it through, things are going to be okay. Crazy. Wish me luck, huh? Got lots of stuff going on. I'm going to head on out. Thank you for watching. Thank you for listening. I'll catch you on the next one.